we're here for this week. You have the opportunity at this time in the challenge to learn the basic structure, some basic steps in keeping your books, enough to gather the information and to get it together for a tax return. Now, I often talk about, for me, and this is for me, over the last 28 years, I've had to pick and choose the hats that I wanted to wear. Because, as a small business owner, and I want to take these off. As a small business owner, we wear multiple hats. We're a lawyer, we're our lawyers, we're our accountants, we're our administrators, we are our own marketers. We're our own cleaning company because we have to clean our own offices unless you have somebody to come in and clean the house. So there are a lot of hats that we wear when we first start our business, right? And as the business grows, you start removing some of these hats because, if you start the business early when you're young, you start having relationships and then you get married and have kids, and your kids are playing all types of sports and activities and dance and cheerleading, all that kind of stuff. And so you're a taxi cab, and then you get older and the kids leave, you have more time. So it depends on what stage of life that you're in as to how many hats you have time to wear, or even if you want to wear them. Because sometimes it's not about money, it's not about time, it's about your self-care, like the attention that you pay to yourself. Because yes, you can do your own books. Yes, you can commit to learning how to do it. I did it. I went to school to be an accountant. I learned how to do this in college. I went to grad school, got an MBA. I went through all types of certification programs to get other credentials. So there was a lot of classroom studying time, homework, all of these things that were done to make sure that I could do what I am doing right now, right? And so being in it for so long, I've just become very good at it, and it's what I love to do. But what I have found recently is that I'm really passionate about helping people and helping people build wealth, but just helping people in general, helping women grow, helping women and men, period. Just helping people grow out of the mindsets that they're in and knowing that they can do whatever it is they want to accomplish. And so I am figuring out the ways that I can do that best. And the first place I thought was teaching people how to do their own books, because a lot of people just ignore it and don't do it. Like I mentioned earlier, they just leave it. Like I literally this week, well, when I say this week, I mean last week, had a client that said that they were not going to report their business income because it was under the table. And I'm like, number one, you're not supposed to do that. Number one, you have to report it, or you're supposed to report it. Number two, you could be doing a disservice to yourself, because if you report that on your business, on your Schedule C, and you write off the losses that are reasonable and necessary for that business, you might have a loss. A lot of times businesses in the first few years will have losses, and those losses could reduce your taxable income from the W-2 job, and you can get that money refunded to you. So your refunds will be bigger. I've had clients, I'm gonna use some regular clients, but I've had clients get back $30,000, $40,000 from writing off expenses from businesses they were not going to claim. I don't know how they thought they were going to do that much money. But the point is, one of my favorite examples is the young single mom or single dad who is taking care of their kids or kids, and they don't make that much money. They're struggling, getting assistance, might be in college. I know when I was in college, I was all over the place. I had a newborn son I was taking care of, and you feel like, I didn't make that much money, so I don't have to file, or I really am, whatever reasons you think, right? I made this under the table. I was just braiding some hair. I was just doing nails. I was just detailing cars or landscaping houses. I really didn't make that much money, so I'm not going to worry about claiming them. But you have a kid or two, you can get free money. Earned income credit is for independent people, like single people that are taking care of a dependent. They're giving you earned income credit. They're giving you money just because you made a little bit of money. Now, you have to be in certain income ranges to get it, but you can get up to $7,000, $8,000 for 3 kids, 4 kids, whatever. Like the minimum for 1 kid is like $4,000 something this year. So it changes every year, but this is money you can get if you made money. But if you're saying I didn't make money because you don't want to report it, because somebody told you because you reported you're going to have to owe taxes, you're doing yourself a disservice. Listening to somebody that has no idea what they're talking about. None whatsoever. So the money that you're making under the table could get you bigger refunds. Maybe you might owe money. Let's say you do have a profit. Think about it like this. And this is one of my things, because businesses for me are a win-win. You are either going to start this business, make a little bit of money, have expenses that are related to you making this money that are reasonable and necessary for that business, and you have a loss. This loss, you deduct it from your W-2 income on your job on the tax return. You have money withheld for your withholding, and because your W-2 income or your taxable income is lower than what it was on the W-2 when they were paying you the money, you get some of that money back. So you get money, okay? That's a win. Now the opposite side of that, I start landscaping yards, and I make $20,000 this year landscaping yards, and I have clients that make triple that. Okay, $20,000 and more than that, but $20,000 you made, right? Total up all the gas you spent for the lawnmowers, all of the money you spent on the weed whackers and the little strings they put in there that I don't know how to use, and all that stuff. You total up all that stuff, right? And you only spent $10,000. You write off your cell phone, you write off your internet because you use internet to correspond with your clients, you use your internet to research different equipment you're using, you use your internet for business stuff, right? You use your cell phone. This is your business phone number that your clients are calling. So you're using all this for business, and you have only spent $10,000. Now, keep in mind, you're not writing off your cell phone on your W-2. You're not writing off your internet. You're not writing off your business meals. You're not writing off any of your business deductions off of your W-2 job. So you're just paying tax money on all of it, right? But with the business, you have all these expenses, you write them off, and you still have a $10,000 profit. Great. You literally made $20,000. You were able to write off $20,000 that you put in your pocket. You were able to write off expenses that you use for your business, that some of them, if you didn't have a business, you would probably have the expense anyway, but you're able to write it off now because you're using it for your business. And then after you write off everything that is legal and necessary for your business, you still have a $10,000 profit that you're keeping in your pocket. Of course, I wouldn't mind paying a little measly $1,500, $2,000 taxes on that money. I'll go ahead and set that aside for estimated payments and pay them $500 a quarter throughout the year as I make that money, because I'm keeping my books and I know what my profit is. If you don't keep your books and you do it at the end of the year, like now, because it's tax time, you got to pay the taxes when you file a return because it's too late to make the estimated payments now. So now you're going to have an estimated tax penalty because you didn't make the tax payments out throughout the year. But that's one of the smallest, but it's still a penalty that is your money that you're giving them because you didn't do what you were supposed to do, which was keep the books throughout the year, right? Keep the books throughout the year, make the estimated tax payments. Even if you pay the taxes on, let's even say 25%. So you pay $2,500, that's still $7,500 that you're keeping in your pocket. Now keep in mind, let's say $3,000 to $4,000 of what you spent on that $10,000, you would have spent regardless of whether you had the business or not, because you got a cell phone, you got internet, you have meals with people where you're talking about doing business, but you ain't never started the business or ain't reporting it as a business. So you would have been able to write it off, but you didn't write it off. You still win. You got money in your pocket. You made money. You pay a little bit of it in taxes. You still win. So it's a win-win no matter what. There are only two major ways to write off items on your tax return that are not already reported to the IRS. And that's going to be on your itemized deductions, which would be like charitable contributions, because some churches do report. They were supposed to be reporting. I know a lot of churches that don't, but they're smaller churches or whatever. Or you could be donating your money to an organization that might not report it, as in send a list of donors and how much they donated to the IRS. So you're responsible for keeping track of that. Now, the churches will send a statement to you of how much they collected from you, but if you put it in a tray and didn't put it in an envelope with your name on it, they're not going to know you gave it to them. They just know it came in as a cash donation, right? So you're responsible for keeping track of what you've paid in your donations. So that is one place that you report money that is not already reported to them. Okay. Taxes, state taxes are reported. Mortgage interest is reported. Medical expenses is another place. However, you don't get to write off 100% of your medical expenses. You get to write off the amount above 7.5% of your adjusted gross income or 10% above your adjusted gross income, depending where your money falls, right? And so the first amount of money that you make, you can't write off, period. So you have to go over a certain amount and then you would report from there.